Welcome to another Leumi Financial Corner. With us once again, Michael Zaremski, head of U.S. Private Banking, Bank Leumi USA, member of Investment Committee for Leumi Investment Services. Michael, always good to speak with you. How are you?
Great to speak with you, Zev. Everything's going well. Hopefully everything's good with you as well.
Thank God. Now, I think in the last one or two conversations we had, we spoke about September being, I say it's the Rosh Hashanah factor, you say it's a September factor, it's a turbulent month, and unfortunately it was so this year as well. How are we doing in October? What are we doing for the fourth quarter?
It's a great question, Zevin. Before I start to answer your question, just want to remind everybody that the views being expressed are my views, not necessarily those of the bank or the broker-dealer. And I think when you think about what our journey is, we look back in 2021, we had 7 consecutive months of positive returns for the S&P 500 from February into August. Every month was very steady, and we just had a very steady upward climb. September came, and as you and I discussed, and as you alluded to, we were anticipating some volatility. Typically, it's been a challenging month for the market, and a lot of market prognosticators were, anticipating, the big sell-off and the end is coming, etc. We've not been in that camp, and I've particularly not been in that camp. But I do recognize that as we continue to get down towards the end of the year, we're seeing a lot more turbulence because there's a lot more uncertainty on a couple of key factors. On the turbulent side of the ledger, so to speak, or some of the concerning parts. On the fiscal policy side, there's a lot of discord in Washington right now. Largely believe that the worst concerns of debt ceiling and government shutdown will all kind of work themselves through. Those tend to be the political flashpoints that each side tries to use as a as a hammer to hit the other side with, but those kind of work themselves out. The big issue right now is what's happening with infrastructure and other emergency spending. And right now we seem to be in a holding pattern and deadlocked a little bit. We're also looking at the situation with COVID. The Delta variant seems to be starting to roll over. We've seen it roll over in other parts of the world. We're starting to see it roll over here in this country. So again, COVID always is the wild card. That definitely put a turbulent spin in September, and we'll see how it goes from here. I remain very optimistic because when I look around at the football games, college, professional, we look at the baseball games, you're seeing full stadiums and people engaged and people out. So that really kind of continues to support the recovery theme. And, in a sense, it also ties into some of the inflation aspects that I know you and I have talked about quite a bit. As people are going out more and as people have a lot of money to spend on their own personal balance sheets as well as corporate balance sheets, people are looking to go back to a time when experiences and entertainment were at the forefront. When we look at the vacation schedules coming up, booking airlines, booking hotels to, desired destinations is getting challenging. To some degree, it's because demand has come back pretty strong. But there's another element of supply is limited because of employment issues. While the unemployment data has improved, and I think we're now down to about 4.8% from slightly over 5%, the other disturbing part of it is that the participation rate in labor markets has also declined, meaning people have stepped out of the workforce. So the good news is we have an economy that's generating more GDP than we did prior to the pandemic. The bad news is that we're doing it with 6-7 million less people working, and that's putting a lot of strains on the supply chain, be it finding people to work in the hospitality industry, people to come back to work in other areas. And, as we look at the supply chain issues on the West Coast, again, they don't have enough longshoremen to work the docks to unload packages. So there's a lot of issues that are sweeping through the market right now that are creating some of this turbulence and creating some of this holding pattern.
So how concerned should we be about the inflation factor, which I know you've been talking about? Seems like, for example, the high price of gasoline, highest price in 2014. We see other indications of prices going through the roof. How concerned? I know, is this something, in your opinion, is temporarily, and as supply is increased, this will go down, or is it here to stay for a while?
It's a great question, Zev, and that's one that's being debated everywhere. I think that in general, the market works pretty effectively in setting prices to mitigate a lot of what we see as this temporary or transient inflation. So as oil prices rise, and now they've kind of started to become sticky in the upper 70s or lower 80s, I would assume that we'll start to see more supply hit market. Again, there are definitely some constraints, whether it's pipelines, whether it's shipping, but eventually I believe that we'll see more flow of energy sources. We don't have a problem of sourcing natural gas or oil. It's a question of getting it to market, and typically these issues work themselves out. In general, I support the fact that companies and individuals will be quite creative in finding solutions. And, for example, you're starting to see now that some of the big box retailers, in an effort to ensure that they have ample product on shelves for the holiday season, they're hiring their own boats and containers and finding their own means to ship. I would assume that means Walmart, Amazon, the like, and some of those other types of companies will likely in some way, shape, or form find themselves in the shipping business. So again, I think that companies will be creative, and I think people will be creative, and I think ultimately it'll be a little bit of time before this works out. But again, there is some element that the government is interested in seeing some minimal level of inflation, and there will be some element that is persistent and sticky. As you and I have also talked about quite a bit, the biggest headwind to inflation, and one of the elements that really helps keep our economy going, is the technological revolution that we've all experienced. And the ability to use technology creates efficiencies, and those efficiencies help reduce costs. So while labor costs may be increasing, efficiencies in technology may be offsetting that to some degree on the other side of it. So I do think that we are seeing elements of inflation. How persistent it is, how long it lasts, is certainly debatable, and I'm not really sure where I stand on it. But I don't think that we're anywhere near a situation of having a runaway inflationary cycle as we've seen in prior decades.
Michael Zaremski, head of U.S. Private Banking, Bank Leumi USA, member investment committee for Leumi Investment Services. Thank you for being with us. Look forward to speaking with you again.
Always a pleasure, Zev, and look forward to speaking with you soon.
And we're going to be right back. Don't go away. Stay tuned.